What's up, YouTube? It's the Action Figure Grader coming back to you with another video. This is a follow-up to my stagflation video. I did a little bit more research, and there's been a lot more data that's come out just in the last few days that I think supports the idea that the U.S. is headed for an economic recession sooner rather than later. And I've got all of the data to prove it. It's very convincing. It's very convincing just after doing probably about an hour or so of research over the last day or so, and I just thought you'd like to take a look at it. One of them came out today, March 22nd. I don't know when I'm going to upload this video, probably Friday, so it'll be a little bit out of date. But Carl Icahn is an activist, investor, billionaire, and he usually, whatever he usually says, it's people pay attention to. Sometimes he's right, sometimes he's wrong, but he does tend to get a lot of things right, and that's why he's as wealthy as he is. But he said that an economic downturn could be on the horizon, and he's loaded on protection against a steep sell-off in the market. And I think he's talking about the stock market here. There is a lot of data that I think concerns me, and mainly it's tied to oil prices. Oil prices are really jumping. Inflation, as a result, is jumping. There's a tight labor market, which also is putting a big problem with inflation. Everyone says, well, you know, the unemployment rate's so low. How could we be headed for a recession? Well, I think that the thing you got to keep in mind is that in order to get people off of the sidelines, there's a lot of people that just aren't even looking for work right now. They're just sitting on the sidelines because of COVID or whatever reason. They're just not out there actively looking for work. And as a result, people who are qualified, they're only being enticed back into the workforce with increased wages. And you see that wages are jumping like crazy. The problem is purchasing power is not, because of inflation. And we also know that the Fed is raising rates. And so I wanted to talk more about that as well. As rates go up by the Fed, the federal funds rate, the rate that they lend, or banks borrow and lend to each other at on the nightly basis to keep their balances in order, that raises the cost of capital for everybody else. As the Fed raises the federal funds rate, mortgage rates go up, credit card and interest rates go up. If you buy a car on credit, then that rate's going to go up. So everything gets affected. And what's interesting is that the mortgage rates, the 30-year mortgage rate for buying a house, it has spiked very quickly after the Fed has indicated that they're going to be raising rates at least 6 more times this year. And they were expecting, the Fed was expecting rates to hit about 4.5%, which is still historically low, make no mistake. They were expecting it to hit 4.5% by the end of this year. Well, as of right now, the mortgage rate for a 30-year fix is at 4.72%. So it's already blown past that number. So it's a big concern. But the war in the Ukraine, rising oil prices, inflation, and of course the Fed's own commentary during their last meeting says that, saying that they're going to raise rates pretty quickly to kind of fight off this inflation bug. And as a result, 30-year mortgages are jumping like crazy. At this time in 2021, rates were at 3.45%. Now they're at 4.72%. That is a massive jump. And if you look at the chart, look at the chart here. This is pretty incredible. Now, this is January of last year, right? Or excuse me, January of last year would be right in here. So January of last year, we were right around, we were under 3%. Under 3%. Look at how much it's jumped just in the last, let's call it 13 months. That is an incredible number. So right now we're in March. It was right around 3.1%. The 2021 average for the entire year was about 3%. But look at how much it's changed just in the last 3 months. And again, part of that is inflation. Part of that is the Fed raising rates already, and the war and everything else. So it's a concern that the market is reacting so rapidly now. They're trying to create, the Fed is trying to create a soft landing with inflation to try and slow down things just a little bit to keep prices in check. But it's having the opposite effect. It's not going to be a soft landing, I don't think. And that's something else that Carl Icahn said. He said that, that they're trying to get a soft landing. I really don't know if we can engineer a soft landing. I think there's going to be a rough landing. Inflation is a terrible thing when it gets going, and it is going right now. And make no mistake, folks, you're welcome to go back and look on my channel. I was talking about this 9 to 12 months ago and how inflation was rearing its ugly head already. And I'm not kidding, but a lot of viewers thought I was crazy. They thought that my opinion of inflation was overblown. And we've got historical level inflation now, the highest it's been in 40 years. And I said it was going to happen. I told you it was going to happen before it actually really got going. So you need to keep a lot of this data in mind, and it's out there. It's not like I'm some Nostradamus of finance here. All of the data is out there. It's just a lot of people choose to ignore it, or they're not reporting on it. But if you look at this massive jump in mortgage rates in such a short time frame, it's pretty incredible, really. The only thing that I think is comparable for me in my lifetime was in 2008 during the Great Recession, going back the other way, right? It went from like 6% down to about 2 or 3% overnight for those banks that actually survived 2007, 2008. It was kind of a mess, the whole thing. Okay, so traders are betting on an aggressive Fed, and they're predicting half a point rate hikes in May and June. That's pretty unheard of, because the Fed has not done that in a long time, where they've added a half a point. Usually they do it in quarter point increments. They just did one of a quarter point, but they're now expecting to raise from almost, let's call it between 0 and 0.5%. They're expected to reach 2.25% on the federal funds rate by the end of the year, and a peak of 2.75% by September of 2023. So we're talking about going from between 0 and a half a percent to 2.75%. That's basically a 450% jump in the federal funds rate. That's a massive change between now and September of 2023. And as a result, the Federal Reserve Chair, he's worried about inflation. It's very clear that he's made it very clear that he's worried about it. And, he said that inflation is much too high, and that the central bank will take the necessary steps to ensure a return to price stability. I think my biggest problem is that this information, this data was out there, and I said in my videos from 6 to 9 months ago at least, that they were reacting too slowly. The Fed was acting too slowly. You can go back and look it up on my channel. I said they should be raising the federal funds rate now, back in June of last year, when all this data started to really hit the fan. But they did nothing. They sat on it. They sat on it during what, in my mind, was a better economy. I know that we were just coming out of COVID, but it would have prevented a lot of this kind of sudden spikes like that we're seeing here. The opportunity for a soft landing, for a soft slowdown in this inflation, was there last spring and summer, but the Fed chose not to do anything. And as a result, we get what we get now, where they say they're trying to hold down prices by raising the federal funds rate by 450% between now and September of 2023. And this is a really good article. I'm going to put a link to this in the description for this video. This is a consulting firm, and this came out on March 7th. And they said that the chances of recession are about 90%. And I think it's probably about right. I think it's closer to 99% right now. I think we're kind of already starting the recession. And again, this comes back to some of the comments I heard. It's like, unemployment rate is at a near record low of 3.8%. Employers added over 600,000 jobs to the payroll in February 2022. So how can we be nearing a recession? Well, home prices are up. They're the highest they've ever been, which is true here locally. These figures scream no recession, which they do. On the surface level, it seems like our economy is humming along. But there's a problem with these traditional metrics. They are present-day indicators. They are not forward-looking indicators. They're actually not even present-day indicators. They're actually past indicators. We're getting this information in March, when the data is really from January and February. So it's really backwards looking, if anything. It's not even present day. So keep that in mind. They're the last figures to change once a recession is underway. That's the key right there. Unemployment data and home price data, those are always lagging. They're called lagging indicators, meaning that by the time we're in a recession, we're just going to start seeing those things be affected. And keep that in mind. What says that there is a recession in 2022? The obvious stuff that we've just been talking about. Record-setting oil and gas prices. The average cost of a gallon of gasoline right now is $4. Here locally in where I live, it's closer to $4.50. For premium, it's $5.20. $5.20. That's up over 50% in 1 year. 50% and 75% from 2 years ago. Think about that. Gasoline has gone up by 75% in 2 years. Higher gas prices are a nuisance to us, but they're also a warning sign of economic trouble. The last time gas prices were this high was July of 2008, a mere 2 months before the Great Depression. And here is a great chart that you got to take a look at. Anytime we've had, almost every time, we've had major price spikes, we've had a recession. These yellow bars that you see in the chart are when we had a recession, and the line, the reddish kind of purplish line that you see here, those are gas price spikes. It almost perfectly coincides with any kind of mini or major spike in gas. And some of the times it's had a spike and a lag. This time in around 2010, 2012, we had a pretty big spike there, but we did not get a recession then. And I think it's because we've already had such a major recession in 2007, 2008. It took forever to get out of that recession, and we were kind of already coming out of it by then. Finally, we'd already been in this recession. This recession lasted a lot longer than what you see here, this little yellow bar. That 07 to 08 recession, the Great Recession, that lasted really about 2 or 3 years. So I would argue that this spike that you see here was still during that Great Recession. But look at all these other ones. All these other ones were during great gas spikes. And here's where we are right now in March of 2022. We are at a massive price jump. It's at 76.8% versus this time 2 years ago. And you can see what the price jump has done, and we are overdue for a recession, in my opinion, just based on that data. So it's really interesting. It's a warning signal that future economic trouble is coming to us, because people are going to naturally tighten up. I forgot what the percentage is, but I think it's around 80% of the U.S. economy is spending. Consumers buying stuff, no matter what it is: food, clothes, discretionary goods, restaurants, live events, whatever it is. That's about 80% of the U.S. economy. So when you got to tighten up because of higher gas prices, a 75% higher gas price than 2 years ago, it's naturally going to have an effect on consumer spending. We have to, because as I've talked about earlier, wages are going up, but buying power is flat or down because of inflation. So I think we're gonna see a recession soon. The other big data point that they point out in this article is that the yield curve is about to invert. And what does an inverted yield curve means? It means that a short-term interest bond from the U.S. government is earning more than a long-term bond. That it's an inverted yield curve. Usually you should get a higher rate of return the longer you have to hold the bond, because you're taking more quote-unquote risk, right? But the interesting thing is that it's about to invert again. And you can see where it's happened in the past, where the short-term return is actually higher than the long-term return, and it's about to invert right here. But in past instances where we've had an inverted yield curve, 1, 2, 3, 4, 5 of them since 1980 or 1979-ish, they've always been followed by a big recession. And so you can see the one in 1978, we had a big recession in 1980. We had a second one during the S&L crisis in the early 1980s. We had another one in around 1991. That followed another inverted yield curve there. In 2000, we had a big one right after the internet.com bubble burst. So that recession is related to that. Obviously, we had this major one that followed the inverted yield curve in the 2007 to 2010 Great Recession. So we're getting there. We're getting really close right now. And I think that you could argue that it's coming. And also, I will note this: while it didn't quite invert too much, that did precede a mini recession, so to speak, during COVID, right? That's what that thin gray line is right there. That's from COVID. So anyway, we're getting close to that. I'm not saying we're there yet, but the warning signs are out there. I mean, the data. This is all just plain data that I'm presenting to you, and I'm showing you past instances where recessions happen after these economic indicators showed they were going to happen, right? Whether it's gas prices or whether it's the inverted yield curve. All of this data supports the argument that the U.S. is headed for a recession sooner rather than later. And so what does that mean for you? A couple things. First, on the collecting side of things, don't over extend yourself, right? Keep within your budget. Don't go crazy, right? If you have a tighter budget, now's a really good time to start tightening that up. Maybe start some of that money that you would be putting towards your collecting budget for whatever it is, comics, action figures, whatever. Make sure that you keep in mind that, hey, maybe my income isn't going to be what it was this year. Maybe my income in 2022 or maybe into 2023, maybe it's coming where it's not going to be what it was in 2021, and start stockpiling a safety net, so to speak. Emergency fund. I always recommend a 6-month minimum emergency fund, and it's come in handy for me. I mean, I'm in real estate, so back during the 07, 08 recession, nobody was buying a house. Back during the 9/11 attacks, nobody bought a house for 6 months. And so my income was a big fat zero, and I prepared for it. I have an emergency fund set up, and I think along those lines, I don't know if it's subconscious or what, but we've talked about collecting fatigue. We've talked about taking a break on collecting, and maybe subconsciously I'm worried about where the economy in the U.S. at least is going, and so I'm not making any big ticket purchase items because I'm a little bit worried about where we're going to be in 6 or 9 months. And I think that's probably about when we're going to start seeing some major recession signs, is in the next 6 months. I hope I'm wrong. I really do. But all of this data that I just showed you points to a recession coming sooner rather than later. Thanks so much for watching, and I'll be back soon.